Hey guys, it's Paul here from Blossom on my channel, Better Call Paul. If you recall in one of my last videos, I think my portfolio reveal, I stated that in September, I was going to buy the Harvest Shopify single stock ETF with the ticker SHPE and put that in my tax-free savings account, which I still plan on doing. But as everybody may or may not have heard yet, there's a new provider in Canada who's, well, they're not new, but they've decided to get into the covered call ETF space and release their own 10 individual stock ETFs. And, I guess they're throwing their hat into the game. And I tell you guys, this is a growing industry. This is not a dying investment strategy. This is a growing investment strategy. So, anyways, guys, just as a disclaimer, remember I'm not a licensed financial planner. So, this is not financial advice. Guys, I'm just sharing with you my journey. I am officially retired. Monday was my last day. So, I'm technically living off of my portfolio. I think I have one paycheck left coming, and I'll probably apply for EI, but otherwise, I'm not employed at the moment. So, anyways, guys, what I decided to do for today's video is I decided to do a comparison video between the two Shopify single stock ETFs from Harvest and Ninepoint. So we can take a look at them side by side and maybe decide which one you want to buy. Now, what I decided to do was I bought both of them yesterday in identical amounts within a couple of minutes of each other. So, it's not influenced that, I bought one while Shopify was up and the other one while Shopify was down. I bought them exactly at the same time. And I'm going to continue adding to the position in that way. So when I get more distributions into my tax-free savings account, probably on the 8th or 9th of September, I will equally purchase more units of both funds, dollar amount. All right. So this is, I put together a little spreadsheet for you guys so you can kind of take a look and see. We'll go over what they have in common and what some of the differences are. All right, guys. So you can see here we have Harvest ETFs versus Ninepoint Partners. And they both, okay, so the ticker for Harvest is SHPE, and then the ticker for Ninepoint is SHHI. So the underlying stock for both of these is it's Shopify, right? The inception date, only a day apart, August 21st and August 22nd. Now, Harvest decided to launch at $12, which is normal for them. That's what they launch at. And I think Ninepoint decided to be a little bit more attractive and a little bit more competitive by launching at $10. Maybe that's a little bit more attractive to people. If you have $100, you can buy 10 shares. So they launched at $10. Current price when I was making this video, the Harvest one was up to $12.10 and Ninepoint was down to $9.87. So both of these ETF providers are using an active covered call strategy. Both of them can use up to 50% of the portfolio to write their covered calls on. Both of them have decided to use modest leverage of 25%. And personally, I like the leverage because I'm not currently using any margin. I'm not borrowing money or increasing my income myself by doing that. So I like it when the ETF fund providers do it for you. As far as I'm concerned, that's less risky. I don't ever have to worry about being margin called. Now, the management fee for Harvest is 40 basis points or 0.40%. I think that's pretty standard for them. So Ninepoint is being very aggressive in this area, and they are waiving the management fee until February of 2026. So that might give them a slight edge. And then afterwards, they are going to set their management fee at 0.29%, right, or 29 basis points. So they are being very aggressive that way, trying to attract people with lower fees. Now, Harvest has set their distribution for this fund at 25 cents. And Ninepoint has also, again, been a little bit more aggressive, saying that they can produce 27 cents. And when you think about it, that's on a lower share cost. So you're going to end up with a higher yield on cost. So definitely being a lot more aggressive. Distribution frequency will be the same for both monthly. Now, Harvest, they list this as a high risk investment. And for some reason, Ninepoint has decided to say that it's medium to high risk. So, but I think personally that they're probably both equally risky. You know, you're taking on the same level of risk regardless of which one you purchase. So, some of the highlights of these funds, guys, and I think this goes for both of them, is that they offer significant monthly income via covered calls and leverage. They're both tax efficient, so dividends generally treated as eligible dividends or capital gains in Canadian tax accounts. And they only Shopify exposure, so they're both concentrated single company risk. All right, guys. So, like I said, I decided to buy both of these. Originally, I had intended on only purchasing the Shopify one, but then I found out about the Ninepoints one. And I will admit, I'm very attracted to the lower fee, although I usually don't really worry too much about fees. But in this case, if we're comparing apples to apples and one has a lower fee, why wouldn't you, take advantage of that? And also, and more importantly, is the lower share price and the higher distribution. So if that, well, right off the bat, you're going to get more shares and you're going to get a higher distribution. So if they can sustain that, then my prediction is going to be that Ninepoints will outperform Harvest. But we're going to have to wait and see. I just bought these yesterday, so I'm going to keep buying them. I'm not sure how many shares I want of each or how much I want to invest, at least $1,000 in each, but probably more. And I'm going to keep track. So the next video I do, I'll put together a table of how many shares I have, how much I've invested, what the current value is, the current balance, and then any distributions that have been paid and what the total return is. So I think this is going to be a lot of fun, guys, and we can compare the two and see which one we decide is, I guess, the winner. Let me know if you enjoy this kind of, an ETF battle where we compete one ETF provider against another and see which one can outperform. And let me know in the comments below. Also, if you like this kind of content, please subscribe to the channel because I'm going to try and put out 3 to 4 videos a week. And guys, this isn't just me making content, trying to, get people to watch. This is my entire portfolio. This is how I'm generating income to live off of. And we're going to see together whether or not covered call ETFs can actually sustain you in retirement and whether or not NAV erosion is real. Anyways, guys, also in the first comment below, I will put a link to Blossom. I do get a whole $5 if you join Blossom. You can use my link or you can just join. It doesn't matter to me. I just want everybody to be on Blossom so we can all talk together, we can all share together, and we can all learn more about finances in a friendly manner. All right, guys, that's all for today. Bye for now.